The Federal Reserve announced its latest decision on interest rates this afternoon, keeping its benchmark rate steady yet again. And from oil to AI, the central bank had a lot to consider. Karen KVUE gives us a look at what it means for your money.
The Federal Reserve's latest decision on interest rates Wednesday came amid a cloudy economic picture.
The committee remains resolute. You've heard this before, but we will deliver price stability.
The government's June Consumer Price Index showed a slowdown in year-over-year price increases last month as a ceasefire between the U.S. and Iran prompted a drop in energy prices. But tensions have flared again, and oil prices pressed above $100 for a time again last week. It's an inflationary dynamic the Fed can't control.
At the core of Iranian strategy, I think, lies the desire and attempt to maintain pressure on global energy markets and by extension on the U.S. economy.
That's left the Fed to mull over how long energy inflation may stick around, and consumers feeling a double squeeze of elevated inflation and possibly elevated interest rates to try to keep it in check, making borrowing more expensive.
I think we all have to assume that inflation is here for a while, higher rates are here for a while, rates may go up further, and so we have to make our decisions going forward as though this is where we are and we're not going to see relief for a while, just in case.
The Fed has also been eyeing a creep in AI-related inflation. Data centers are driving demand for electricity and construction supplies and workers. And a surge in demand for memory chips is making consumer electronics more pricey. In Washington, I'm Karen KVUE.